redistributed, or quoted in any public forum or media communication without the company's prior written approval. I now hand the conference over to Ms. Sheetal Khanduja from Goenka Advisors. Thank you, and over to you, Ms. Sheetal.
Thank you, Ikra. Good morning, everyone, and welcome to Vikram Solar's earnings call to discuss Q4 and FY26 results. We have the senior management team with us, and joining us on the call today is Mr. Gyanesh Chaudhary, Chairman and Managing Director, Mr. Sameer Nagpal, Chief Executive Officer, Mr. Ranjan Jindal, Chief Financial Officer, and Ms. Reenal Shah, General Manager, Corporate Finance. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Chaudhary to take us through the company's business outlook and financial highlights, subsequent to which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Sheetal. I hope I'm audible. Good morning, everyone, and a very warm welcome to Vikram Solar's fourth quarter and full year FY26 earnings conference call. On behalf of the entire Vikram Solar management team, I would like to thank our investors, analysts, and stakeholders for your continued confidence and support. FY26 has been a year of great significance for us, and I will walk you through three things: how the operating environment has shifted, what we have built, and where we are headed. My remarks will follow by a detailed operational and financial walkthrough from our management team. Now, the geopolitical disruptions for the past 2 years, most recently in West Asia, have reinforced one reality. For import-led economies like India, energy dependence is now a structural risk, not a price cycle risk. Disruption in oil, gas, and freight routes are no longer temporary shocks. They are a permanent feature of the global system. Solar uniquely sits outside all of it. The result is fundamental shift. Solar is no longer being pulled by incentives. It is being pushed by policy, by supply chain realignment, and by energy security. Security, economics, and policy are now aligned, and solar sits at the very center of this energy transition, not at its edge. This is the world Vikram Solar was built for. Just weeks ago, Mr. Amitabh Kant, former CEO of Niti Aayog and India's G20 Sherpa, described India's import dependence as a national security crisis, not merely an energy issue. He called for non-fossil fuel capacity to be scaled from 500 gigawatts to 1,500 gigawatts by 2030, alongside large-scale storage and critical mineral processing at home. His framing, energy independence is sovereignty, captures exactly the moment we are operating in. India is currently the world's third largest solar market by annual additions. Industry assessments project us moving to second within the calendar year. This is huge. We are not chasing a cycle, we are building for the coming decade. As we scale into more integrated, execution-focused organizations, I am pleased to welcome Sameer Nagpal as our Chief Executive Officer. Sameer brings over 35 years of leadership experience across a diverse set of sectors, with a proven record of architecting turnarounds, building high-performance teams, and driving profitability. Please do join me in welcoming him. His mandate is also very clear: driving operational discipline across the platform, strengthening execution rigor, and aligning the business for the next phase of growth. I now turn to what I believe is the most consequential strategic decision we have taken: our backward integration roadmap. India today imports nearly all of its wafer and ingot from China, creating supply chain vulnerability for every domestic manufacturer. Vikram Solar will capture that value chain upstream and convert India's solar surge into enduring, non-transient profitability. Our integration strategy moves into 3 deliberate stages. modules first, then cell, then wafer and ingot. Each stage adds depth, reduces exposure, and brings more for the value chain under our control. By the end of this roadmap, Vikram Solar will be fully integrated from ingot to module. Let me now turn to battery energy storage. What I view as the next major growth frontier for Vikram Solar. Battery energy storage is policy anchored, margin accretive, and the piece that converts intermittent solar into dispatchable power. As India's grid deepens and as data center and AI-led load grows, storage is no longer optional infrastructure. It is non-negotiable. Our target is 15 gigawatt of BESS capacity by FY30, positioning Vikram Solar as one of the leading, largest integrated solar platforms and aligned with the national pathway I was referencing earlier. This completes our energy platform, and it takes us from a product company to a complete energy solution provider, delivering solar plus storage as dispatchable power. Vikram Solar is positioned to be the partner of choice for this transition. In summary, FY26 has been a record year for the Indian solar sector, and Vikram Solar has delivered alongside it. More importantly, FY26 is the year in which we made the decisions that will define our next decade. On manufacturing, on integration, on leadership, and on storage. The direction is clear, the team is in place. We remain fully focused on delivering for our customers, our partners, and our dear shareholders. With that, I now hand over to our CEO, Samir, over to you.
Thank you, GC. Good morning, everyone, and thank you for joining us. FY26 has been a blockbuster year for Vikram Solar, and Q4 is the clearest expression of the momentum we are carrying into FY27. We delivered our highest ever quarterly production of approximately 1 gigawatt, secured our highest ever order booking of approximately 1.9 gigawatt, and recorded our highest ever quarterly revenue of over 1,450 crores. Each of this is a record in its own right. Together, they tell a single story. Demand for our modules is accelerating, our execution is keeping pace, and the operating leverage of the platform we have built is starting to show through in the numbers. These results are not occurring in isolation. They are landing into a sector that is itself entering its strongest phase of structural growth. And Vikram Solar is positioned by capacity, by technology, and by provenance to capture a disproportionate share of it. What you are seeing this quarter is the early innings of a multi-year trajectory of strong growth for this company. I will use my remarks to do three things. Lay out how we read the sector at this point of time in the cycle, walk you through where Vikram Solar stands within it, and give you a concrete update on the projects and the technology choices that will define the next 3 years for this company. Let me walk you through our view on the sector. FY26 is a watershed year, as I said, for the Indian solar manufacturing. And I want to be specific about why. India added 45 gigawatt of solar in FY26, nearly double the 24 gigawatt target, and roughly 87% higher than FY25. Cumulative installations now stand at 150 gigawatt, or 53% of India's 283 gigawatt non-fossil base. The CEA's National Grid Action Plan projects India's peak demand rising from 289 gigawatt today to 459 gigawatt by FY36. Installed solar base must scale from 150 gigawatt to 509 gigawatt, roughly 3.5 times of today's base. Battery energy storage currently below 1 gigawatt hour must reach 320 gigawatt hour by FY35. We have reached a pivotal maturity phase in the industry where policy certainty is aligning for vigorous push for backward integration. ALMM and BCD continue to provide the necessary guardrails for domestic growth. The cell level mandate, effective June 2026, is a critical milestone. It forces a shift from assembly to true manufacturing. Together with the wafer invert mandate, it forms a coherent industrial framework, one that rewards operational depth. The discussion around the headline module capacity announcements will be addressed by the imminent backward integration. Given the barriers of capital access, technology, execution capability, and customer intimacy, and a regulatory framework that requires integration, only a few will sustain. Our working assumption is that the sector will stabilize around 80 to 100 gigawatt of nameplate fully integrated sustainable capacity held by a small group of serious full stack players. And the total addressable market is heading towards a similar number. The three factors that matter most to an industrial company's long-term competitiveness are converging in our favor simultaneously. Growing domestic demand, local manufacturing depth, making integration a competitive mode rather than a cost. And at the center of the opportunity sits a company that has built the hard things. 9.5 gigawatt of module manufacturing at scale, and soon going to be ramping up to 15.5 gigawatt. A technology platform which has transitioned well to N-type, a well-established customer base, and a clear integration roadmap. Let me now give an update on our project execution. Our execution capability is best illustrated by Vallabh, which is, in our view, one of the fastest greenfield module manufacturing builds of this scale in India. We took the 5 gigawatt facility from ideation to commissioning in under 9 months. Beyond the timeline, the project delivered measurable operating gains, lower manpower intensity, faster line throughput, reduced defect rates from day one. Having set a 9-month benchmark and delivered on it, we are now replicating the same playbook at Gangai Kodal. At Gangai Kodal, the 6 gigawatt module facility is in the final stretch of completion, with the first module output on track for June 2026. On the 9 gigawatt TOPCon cell facility, civil and PEB works are well in advanced stage and on track for completion by September 2026, with clean room and MEP completion in October. Equipment installation is sequenced across October and November. The power infrastructure, which Siemens is executing for us, is scheduled for commissioning in November. Utilities build out follow in December. We anticipate the first sell out end December, early January, followed by a sequential commissioning through March 2027 and a subsequent production ramp up during Q2 FY28. What separates Vikram Solar in this cycle is a deliberate technology-first capital allocation philosophy. 20 years of execution through every meaningful technology pivot the industry has been through, from multicrystalline to monopoly to N-type TOPCon, has taught us that the cost of choosing the wrong vintage of equipment is paid for the entire operating life of the asset. We have made our peace with that lesson and build our CapEx strategy around it. Concretely, we have placed orders for the cell equipment, all belonging to the latest TOPCon Plus generation, with efficiency enablers built in from the outset to deliver a meaningful markup over the industry baseline. And they translate directly into a higher watt peak per cell, more consistent module performance, and better realizations over time. Our next 3 gigawatt of cell capacity will be of a superior technology with incremental efficiency in the subsequent year. In the closing, I would like to give my outlook on where we will be in the next 3 years. Fast forward 3 years, and the picture for me is straightforward. Vikram Solar will be operating its 6 gigawatt wafer ingot facility, which will scale up to 12 gigawatt by FY30. It will be operating its 12 gigawatt cell facility, 15.5 gigawatt module capacity, fully integrated, technology current, and one of a small handful of serious full stack manufacturers in India. Against this, we have an industry that will have rationalized to roughly 80 to 100 gigawatt of sustaining capacity and a similar demand envelope. That is the company we are building, and the records we have set this quarter are the first visible markers of that trajectory. You will see it take shape quarter by quarter as we go forward. Thank you, and with this, I will hand this over to Ranjan for a next review.
Thank you, Samir, and good morning, and thank you everyone for joining us. I'm accompanied by Rinal Shah from our investor relations team, along with our advisors, Go India. Our Q4 and full year 26 earnings presentation has been uploaded on the exchanges. FY26 has been a strong year for Vikram Solar, with a solid Q4 closing out a record full year. Every key metric, be it revenue, volumes, EBITDA, PAT, has reached an all-time high. During the year, the company delivered record revenue of 4,800 crores, up by 40% year-on-year. This was supported by sales volume of 3.3 gigawatt, a 76% increase from 1.9 gigawatt the previous year. Crossing the 3 gigawatt shipment mark in a single year is the first for Vikram Solar, which places us among the leading Indian solar manufacturers. EBITDA for the year recorded at 917 crores, with margins expanding to 19%, a 500 basis points increase over 14% in FY25. This reflects the operating leverage we have spoken about as our expanded capacity has come on stream now. Profit after tax for the year was at 470 crores, a 10% PAT margin. It is a meaningful milestone and one we can expect the platform to build on consistently from here. Q4 was a strong quarter and a fitting close to the year. As Samir mentioned, we touched a 1 gigawatt quarterly run rate for the first time, providing a useful operating baseline going into FY27. Revenues for the quarter were at 1,450 crores, up by 31% sequentially, with EBITDA at 235 crores at a 16% margin and PAT at 110 crores. Our balance sheet is in a very strong position. The net working capital cycle has compressed from 82 days in FY25 to 44 days in FY26, reflecting tighter receivable management, more disciplined inventory deployment, and timely cash generation of the scale platform. Importantly, the company carries no long-term debt. Working capital net debt at just 64 crores and a net to debt equity ratio of 0.03 paves the way for the next phase of our capex cycle from a position of financial strength and flexibility. During the year, we crossed a 10 gigawatt cumulative global module deployment. This represents over 25 million modules supplied, supporting power generation for more than 5 million homes in India. We have scaled from 5 gigawatt to 10 gigawatt in just 2 years, reflecting steady execution in such policy-supportive environment. Our order book stands at 8.2 gigawatt as on 31st March 26, providing revenue visibility for the next fiscal. The mix is anchored by IPPs at 69%, CII at 13%, government and EPC at 18%. This balanced composition gives us good visibility, quality counterparties, and the flexibility to direct production towards the most attractive segments as the cycle evolves. Through it all, our business model held up exactly as designed. Long-standing relationships that do not move on every price tick and that allowed us to hold blended realization steady. Approximately 80% of our order book carries sell price pass-through clauses, insulating the PL from any input volatility. And as volume scaled, per watt overhead came down 16% on a full year basis. The result, stable margins, a more diversified mix, a stronger operating leverage, and a clear demonstration that we will build to grow through cycles, not just in the benign months. In short, FY26 has delivered record growth, record profitability, and a healthy balance sheet, a solid platform to engage with what is unfolding in the broader market. Let me place these results in the context of the industry backdrop. FY26 has been, by multiple measures, the most consequential year in India's solar industry and a defining year for Vikram Solar as well. The demand numbers tell their own story. Utility scale projects led the charge with a record 34 gigawatt of additions in FY26, the highest ever in a single year, while rooftop solar crossed a milestone of its own at 8.5 gigawatts, powered by the rapid uptake of the PM Surya Ghar Yojana. Together with the broader distributed segment under PM Kusum, India's overall capacity built for the year reached unprecedented levels. This is no longer an incremental growth, it is a structural reset of India's energy architecture and is happening in reality now. FY26 paired the strongest demand environment India's solar industry has ever seen, with a few cyclical supply-side pressures. The kind of a cycle is scaled, integrated manufacture is built to absorb. We navigated it from a position of strength. Cell cost moved up during the year on higher silver prices and the removal of China's export VAT rebate, and the domestic manufacturing ecosystem continued to scale, naturally bringing more competitive pricing dynamics. These are familiar features of an industry in rapid expansion, the ones we have managed through multiple cycles. For FY27, from a market standpoint, demand continues to be anchored in non-DCR in the near term, while gradually transitioning towards DCR. Vikram Solar's strategy is to participate meaningfully across both the segments going forward, supported by a favorable multi-year demand outlook. While our production will continue to be predominantly aligned to the non-DCR market in the current year, we have also proactively positioned ourselves for the emerging DCR opportunity, including through a 2 gigawatt procurement agreement. We see strong structural tailwinds going forward. Over 80 gigawatt of grandfather non-DCR demand over the next 2 years, along with approximately 28 gigawatts of live utility scale DCR tenders, providing a robust runway for the core utility segment, and around 25 gigawatt of inherent DCR driven by C&I, Kusum, and rooftop segments. Put simply, the demand environment is the strongest and most durable we have seen. The policy framework is moving decisively in favor of integrated domestic manufacturers, and Vikram Solar enters this space with the order book, the customer franchise, and the balance sheet to capture more than our fair share of it. The natural question then is how we convert this once-in-a-cycle opportunity into long-term, defensible market leadership. That is the lens through which our CapEx strategy has been built and how our thinking has evolved over the last year. Let me lay out our integrated capacity roadmap. On the module front, we are at 9.5 gigawatt today, scaling to 15.5 once Gangaikondan 6 gigawatt module plant commissions. Our 9 gigawatt TOPCon cell plant is on track for phased commissioning through Q4 FY27, with the first cell rolling out in December 26, taking us to roughly 70% of backward integration. A further 3 gigawatt cell is planned in FY28, completing the cell stack and taking us to a full cell level integration. Moving on to the next phase of our integration journey, of the 12 gigawatt wafer and ingot facility, we plan to add the first phase of 6 gigawatt at the existing site at Gangaikondan, the investment of which was approved at the board meeting yesterday with an expected outlay of approximately 3,700 crores and commissioning in FY29. This addition turns Gangaikondan into a single integrated solar manufacturing campus, ingot to module, with zero transport cost between pads, zero transit damages, and nil inventory buffers between stages of the value chain. The structural cost and quality advantage is significant. The journey for the 15 gigawatt hour BESS capacity has also kick-started, wherein a 5 gigawatt hour cell to pack facility is scheduled to commission by March 27, followed by the first phase of 7.5 gigawatt hour of battery cell manufacturing to commission in February 29, and the second phase in FY30. The aforesaid CapEx programs shall be met with a disciplined mix of debt and equity. Capital prudence is non-negotiable. We are committed to operate within firm guardrails through the entire investment cycle, maintaining interest and debt service coverage ratios above 2.5 and the net debt to equity below 1.5, even at the point of peak debt drawdown. The phasing of CapEx, the sequencing of debt tranches, and the build-up of internal accruals have all been calibrated to stay comfortably within these limits. Growth ambition will not come at the cost of balance sheet discipline. To summarize, as we close out what has been a historic year for the company and for the Indian solar industry, I want to leave you with 4 clear and durable takeaways from today's call. The earnings base is real. Record revenue, record margins, double-digit PAT, and a strong balance sheet with no long-term debt. The platform has already proved it can generate the cash to fund what comes next. Order book strength, repeat customer depth, demand visibility across segments, and a consistent track record of operational execution is the foundation on which our cash flow projections rest. Secondly, in this environment, scale alone is no longer sufficient. Integration, technology alignment, and execution and customer confidence are becoming the defining factors for long-term competitiveness. Vikram Solar focuses on all these pillars to ensure sustainable growth. Thirdly, CapEx is financed through well-structured, diversified mix. The phasing of actual spends and the sequencing of financing tranches are designed so that no single source, including internal accruals, bears a disproportionate burden in any given year. And fourthly, Vikram Solar is building a platform for long-term market leadership. From 12 megawatt in 2009 to 15.5 gigawatt of modules in Q1 27, from a private company to a public listed company with an A+ credit profile, this is a company that has consistently turned ambitions into execution. The investment we are making today is the foundation for a competitive position that will be defensible for the decade ahead. With that, we would be happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Please note, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sahil Seth from Anand Rathi Institutional Equities. Please go ahead.
Hi, thank you for taking my question. So my first question would be on our 2 gigawatt domestic cell we are procuring from International.
I'm sorry to interrupt, Sahil. Your voice is muffled. Can you use your handset mode, please?
Am I audible now?
Yeah, please proceed. Thank you.
My first question would be on the 2 gigawatt domestic cell we are procuring from Jupiter International. From when can we start to see the DCR modules starting roll out from our manufacturing facilities?
The agreement we signed with Jupiter has been placed in such a manner that...
I'm sorry to interrupt, sir. Sir, can you please repeat? You are not audible. Hello?
Okay. Am I audible now?
Yeah, please. Thank you, sir. Proceed.
Thank you, Sahil. So the agreement we have signed for the procurement of cell has been placed in a manner to take care of the DCR demand, which will kick in post the June 26 deadline. And within FY27, the entire offtake, with a ballooned offtake in the H2, is going to pan out.
Okay, got it. And so my second question would be on the capex front. Now that we have for our 9 gigawatt cell facility, we are now procuring machinery direct from China versus our previous plan to import it from Thailand. What would be the capex differential between those plans? And if you can pan out the capex schedule for FY27 and FY28.
So there was a change in the plan as we discussed. It was a 10% cost increase. So the overall cell capex for the 9 gigawatt would be at 5,400 crores, of which, as we know, that since the commissioning is being done between December 26 to March 27, the deployment for the capex will almost go in the current year, barring the last 10% installment, which will switch on to FY28.
Okay. And sir, for the best component, when would the capex start?
So the assembly for the 5 gigawatt hour would cost about 150 crores, which will be spent majorly in the current year. On the cell manufacturing, we expect to start the construction somewhere in October 26 with the 24 months of construction period. So this financial year will majorly see the amount towards land and initial expenses. which we don't see more than 200 crores.
Okay, got it, sir. And sir, on the wafer ingot capex?
Again, wafer in an ingot, as the commissioning of the first phase of 6 gigawatt, which is planned to commission in March 28, the construction also is expected to start in Q2, Q3. The same concept applies here, but since we already have the land in place at GK, the initial spending for few advances to the suppliers within 100 crores.
Okay. And sir, what about the balance 6 gigawatts of the ingot wafer? Would that incur a similar amount of capex?
Yeah, so the thumb rule of about 600 crores per gigawatt applies there as well. We intend to take the board approval for that in the subsequent financial year.
Okay, that was quite helpful. Thank you and all the best.
Thanks.
Thank you. Next question is from the line of Ankur Gulati from Januity Capital. Please go ahead. Ankur, your line is unmuted.
Yeah, hi, am I audible? Hello?
You're audible. Please proceed.
All right, thanks. Quick question, sir. Some of your peers have been expanding across vertically or horizontally. So any thoughts on more forward integration or horizontal integration?
Let me take that question. At this point of time, we are completely focused on backward integration on the module and expanding into BESS. At this point of time, we are not thinking anything beyond that.
And sir, if you can double click on your BESS expansion plans, please.
As Ranjan mentioned, we are beginning with the BESS assembly, and then we are going to backward integrate into cell manufacturing. He has already answered the question.
All right. Okay. Thanks. All the best.
Thank you. Next question is from the line of Anuj Kapil from Taurus Mutual Fund. Please go ahead.
Hello, am I audible?
You are audible.
Yeah, thank you for the opportunity. So my question is, what was the sequential movement in key raw material costs during Q4, especially for the cells, glass, EVA, backsheet, and aluminum frames? And second question is, what is the current inventory holding period for the critical raw materials?
So, Anuj, right?
Yes.
Yeah. Anuj, we experienced some increase in the crude oil, which impacted the EVA cost. The aluminum frame cost has also gone up with the aluminum cost per ton going from $3,100 per ton to $3,600. But that was partly compensated with the corresponding fall in sale prices. So the current quarter does not see much impact of this increase. On the second part, with the Vallam facility coming in, yes, we have increased the inventory levels. As a company, we do maintain an inventory of 30 days at the plant level, with about 60 days at the vendors and on water level. So that is what the overall cycle we follow. And as also mentioned in my speech, that on the overall working capital cycle, we have brought it down to 44 days, which is net of the credits available from the payables.
Okay. Thank you, sir.
Thank you. Next question is from the line of Kaushik Doshi from ICICI Securities. Please go ahead.
Yeah. Thank you for the question. My first question is, does the 1.9 gigawatt order inflow include the distribution part?
The order inflow does not include distribution. We have taken that out of order booking format.
Okay. And sir, why were the distribution orders removed from the order book?
See, most of our distribution was in non-DCR segment. And we were running a recurring order book with them. That was our arrangement with the distributors. Now, since it is moving to DCR, and we are currently, this year, we are going to operate on a outsourced cell supplies. So we have changed the format to spot buying by distributors instead of a recurring order book.
Okay, sir, got it. And sir, my next question is 6 gigawatt capacity addition is not done yet. If you could highlight the reason behind that.
Sorry, we could not get you. Can you please repeat?
My question was 6 gigawatt capacity addition is not done yet. If you could highlight the reason behind that.
Yeah, it's intact. So it continues to commission within June, and the schedule is intact.
Okay, sir. Got it. I will get back to your line. Thank you and best of luck.
Thank you. Next question is from the line of Akshay from UBS. Please go ahead.
Hi, sir. Thank you for the question, and congratulations on strong ramp-up in production, order book, and healthy cash translation through the year. My question is related to BESS, sir. In presentation, you have highlighted DCR mandate for BESS targeting 60% localization. So in your view, how would policy will target this, and how much the cell cost for BESS BOM, and how much localization can be achieved just through assembly, including containers, electronics, PDS, etc.? That's the question, sir.
Actually, we are extremely optimistic on the policy mandate on BESS, considering it is going to be an integral part of the grid stability mandate, with solar becoming as large as an installed base as it is today. These are indicative numbers given by CEA and the Ministry of Heavy Industries. We are, in addition to the localization mandate, we are also looking at and anticipating a similar policy on approved list of battery manufacturers. There is already an advanced chemistry PLI. On the demand side, the government has done enough, laid out an outlay of about 80,000 crores on the viability gap funding, through which we already have a pipeline of BESS tenders to the extent of about 100 gigawatt hours already in various RFP as well as bid submission stage. So the next 2 to 3 years, we will see an extremely positive policy movement, and the economics of the cell and upstream components will pan out accordingly.
Got it. Thank you. Yeah, that's all. Thank you.
Thank you. Next question is from the line of Praveen Sahai from PL Capital. Please go ahead.
Yeah, thank you for opportunity, and many congratulations on a very good set of numbers on top line. My question first is on the gross margin, and there there is a contraction we had seen, and also we are seeing that the model realization has declined around 13% in the INR terms. So can you please give some more color, like how much is the realization contraction and the RM inflation, how to segregate in the gross margin contraction? And secondly, where you will see this realization to be in the coming year?
So Sameer, let me first give you a comparison as to what Q3 and Q4 on a per watt peak basis appear to be. In fact, the realizations have actually gone up in Q4 by about 60 paise, whereas the cost, as I told in the previous question, by virtue of the impact of the war coming in, the cost actually went up by 80 paise. So that 20 paise additional incremental cost has dented the per unit EBITDA by to that extent, and hence you could see a slight percentage impact on the EBITDA margin level. But as we have already mentioned in our remarks earlier, this business we focus on a per EBITDA watt peak basis, and we see some more rationalization to come in the quarters to come. But with the scale coming in, the absolute numbers are expected to increase.
Okay. Second question is related to the 2 gigawatt procurement. Do you have any anything finalized on the pricing or the spread to be shared with the company?
So this is something which it will be unwise for us to share the commercials, but I can only assure you that the commercials have been arranged such that the EBITDA per watt peak expectation of the company is maintained.
Okay. And on the order book side, 1 gigawatt on the distribution, 1.5 on the CNI. And I understand because of this, the non-DCR to the maybe a DCR coming in. So how you are, the confident of gaining back these numbers? And also if you can give some clarification on 0.6 gigawatt of the US order with Salivate. So where we can see these numbers to come in, basically distribution and the CNI.
As the mandate moves to DCR, the large chunk of non-DCR, all of the non-DCR distribution will move to DCR because of this policy shift. Same thing is, or similar is happening in CNI. So that is the reason why we have removed the rolling 1 gigawatt order book which we were carrying from distribution. On the CNI side, there is a large order book which we had is switching to DCR, and it has gone into renegotiation. So we want to optimize our margins on the DCR portfolio because of the limited supply we have. And that is why we have taken them out of our current order book. Those are under renegotiations, and if they fit our margin profile, we will account them as fresh bookings. So that's the approach we have taken.
And to add to that, distribution still remains a very stronghold and an area of focus for us. As you see, we have expanded our distributor network to about 110 plus 550 plus for dealers and system integrators who are exclusive to Vikram Solar. So even with non-DCR, we did about 20% of our volumes last year through the distribution channel. And that number is only going to multiply now that we have the procurement deal for the DCR. So it is just a way of reporting that has changed. As to your export question, that particular project in question was deemed unviable by the IPP because of sunset of certain incentives in the US market for the IPP itself, which is why we've removed it from the order book.
Okay. Last one clarification. Is there any DCR volume in this quarter?
So hardly any volume. So the main occupancy has been on the DCR, non-DCR front. FY27, as Renal and Samir explained, we'll see the DCR optic to come in.
Thank you for giving me opportunity to ask question, and all the best.
Thank you. Next question is from the line of Bala Murali Krishna from Humanus Investments Advisor. Please go ahead.
Hi, good morning. So the question is regarding the debt level. So earlier we have planned to have a 3,500 crores debt level by the end of FY27. So I think by seeing the investor presentation, we are only sticking to cell facility by the FY20. So by FY28 end also will be similar level, debt level side.
Bala, you'll have to repeat the question for us, please.
Yeah, my question is regarding the debt levels. So earlier we had a plan of 3,500 crores debt levels by the end of FY27. So I think by the because the BESS and other projects are postponed to FY29. So by end of FY28, it's also will be at the similar level of debt level, right?
Yeah. So when we spoke about a debt level of 3,500, the plan was to have entire 12 gigawatt of cell in place, which we have now placed it into 2 of 9 plus 3. But as we also discussed, FY27 will see some outflow for the BESS and the wafer ingot business, which mainly will be from the internal accruals. So the closing debt for 31st March 27 can therefore be considered to be 3,200 crores.
So by the end of FY28, what could be this figure?
So the capex phase for the wafer ingot will come in more importantly there, and we expect that to remain at 6,500, 6,600.
So the question is because earlier we are incurring around 150 crores of interest cost. So by FY27, we could be outflow could be 500 crores, and by FY28 end it could be 800 crores. So the question is, the top line will grow for the next 2 years, and EBITDA will also grow accordingly. But the bottom line could be staggered around this 500 crores level, so because of this interest outflow. Is it a right assumption?
That would be a forward-looking statement, but I can only guide you that in the capex period, the interest for a project is capitalized and it's not charged to the PL. So as we see the commissioning of wafer ingot to come in say March 29 and the cell on say March 27, the PL will have the impact of the component for that date of an asset which is capitalized. Could I answer that?
Okay. Yeah.
Thanks.
So on the order book, secondly on order book front, so we are in the negotiation of converting some non-DCR to DCR. So how would be this mix could be in FY27 by the end of FY27 and FY28?
Can you say that again, please?
Yeah, on the order book front. So we are negotiating some non-DCR orders to DCR. So how do you see this mix between DCR and non-DCR by FY27 and FY28 end?
The non-DCR segment will operate in those grandfathered projects of 87 gigawatt. So depending on how they get finished or get executed over next 2 years, that will determine the non-DCR order book. Rest, everything will move to DCR.
Thank you. Next question is from the line of Deepak Purswani from Swan Investments. Please go ahead.
Hi. Good morning and congratulations for good set of numbers. Firstly, sir, just wanted to check it out. Since there has been a ramp up in terms of the capacity for the module to 9.5 and eventually moving to the 15.5 over the next 3-4 months. If I were to look into the production front, year as a whole, we should be, in terms of the production, we would be close to 7.5 or 8 gigawatt versus 3.2 gigawatt this year. Now, in this context, if you can give us broader sense, what would be our sales strategy in this context? Because if I were to look into the current order book, currently we have the 8 gigawatt order book. What would be the execution out of this in this year? And what would be the incremental sales strategy we would be looking at?
Okay. Thanks, Deepak. So I'll just try to give us to what the overall plan for FY27 is, and then we can see whether the question has been answered. FY27 collectively with the 6 gigawatt module coming is expected to produce collectively for the company as a whole some 8 gigawatt, of which, as we discussed, 2 gigawatt will be on the DCR front and the balance 6 on the non-DCR. So we have an order book of 8.2 as on 31st March 26, of which 7.2 is domestic, of which 6 goes out as we discussed, which therefore leaves us with an order book of 1.2 with a whole year left over to take share of the 87 gigawatt grandfather, which Samir highlighted in the previous question, to then build up for some volumes for FY28 as well.
Okay. Thank you and wish you all the best.
Thank you. Next question is from the line of Bhavna Jain from Avagra Capital Advisors. Please go ahead.
Am I audible?
Yes, you are.
Thank you for taking my question. First of all, congratulations for the good set of numbers. I have a question on the margin front, just repeating what the previous participant asked. What is the EBITDA per watt peak we are making as of now, where we don't have any DCR module?
So, as I discussed, Q4 experienced a number of 2.35 with the DCR mandate getting stipulated strictly from, say, June 26. We are encountering some optimization on the EBITDA per watt peak further. So we therefore believe that for the year as a whole, the non-DCR volume should deliver an EBITDA of per watt peak at 1.75 to 2 rupees throughout the average, on an average basis.
Okay. And after the integration of cells, how much is our expectation it will go to?
So we believe that 1.75 stroke 2, at least for FY28, should deliver about 5 rupees per watt peak, which presently is at 6. So with more of capacities coming in, we expect that to trim down by 1 more rupee in FY28.
Okay, by 28 we can expect that. I mean, you're expecting all that even after the industry overcapacity or the insufficient cell capacity makes it up, including all that, right? I mean, I hope that all factors are considered. Or we expect something.
Yeah, Samir in his opening remarks highlighted that on a country level with full integration with the top 15-20 players who are going to rule the game, what would be the country level supply and the demand? Post that, on a stabilized basis, we think that revenues, that EBITDA per watt peak can continue.
Okay, sure. Thanks for that answer. There is one question about the utilization level. So, at least by FY27, after the module and the BESS or all those, whatever we are completing by FY27, what is the utilization level we think we'll achieve?
On an average for module, we expect on a nameplate basis about 65% to 70% to be a standard utilization. And for cell, that number is higher, between 70 to 75% on nameplate. I'm not talking about effective, but clear on the nameplate.
Okay, thanks. Just one last question. Just curious about this technology that we are using for the cell part. Like right now, all the competitors that we see are applying the HJT technology for the manufacturing, and we are adopting the XBC one. First question is, I mean, do we see any profitability improvement by choosing this new platform? Second is, do we expect higher capex for a new technology? Both of them.
Correct. The industry dominant technology currently is N-TOPCon in both cell as well as module. HJT is the technology used by one of the larger players with a limited capacity, and this is true for global average as well. What we are setting up currently in our first phase of cell plant of 9 gigawatt is also N-TOPCon, but it's a TOPCon plus with incremental couple of processes which gives a leg up in efficiency over the industry baseline currently established at 25.2%. So with the use of these processes, what it does is takes the efficiency level up to say 25.4 or 25.5%, which basically helps us create more wattage in modules and hence translates to better per watt realization. So currently our capex cost is also very in line with the industry. The numbers have been published.
Great. Just last question, if I can squeeze in. What is the company's expected silver consumption reduction, the future roadmap, because that's an area of concern which most players have been talking about.
Right. So like I mentioned, the TOPCon plus cell setup that we are establishing uses a process called LECO, which anyway reduces the silver consumption because of the thinner silver fingers. Going ahead on our roadmap in our R&D and applied research, we have projects which helps us replace or reduce silver consumption, but it's too soon to tell. There are various technologies being researched about at a global level in established labs that we have collaboration with. But at a commercial scale, these are the couple of processes that have helped us reduce the silver consumption for the industry as a whole.
Great. Thank you. Thank you so much for all the answers. Thank you.
Thank you. Next question is from the line of Dhruv Machal from HDFC AMC. Please go ahead.
Yes, sir. Thank you so much. Sir, I just had a question that until the utility scale DCR norms, practically start kicking in, which in my expectation probably sometime in FY28 or some early FY29, where your new cell capacity is well timed to, probably commission. Until that time, just the CNI market, DCR and the rooftop DCR market, probably and versus the cell capacity production which is there available in India, it seems the market is relatively well balanced or to some degree oversupplied, the cell market. So in that context, given your brand power, given your scale and reach, I'm wondering, are you not able to optimize better on this relatively well balanced DCR cell market to